We are just a few seconds away from the government's personal income and spending report. That does include the core PCE data that we're waiting for, too. Dow right now up by 161 points above fair value. Rick Santelli is standing by at the CME in Chicago. Rick, the numbers, please.
Yes, personal income and spending for the month of August starting to populate here. And the income numbers expected up 0.4%. Well, it's exactly up 0.4%. And if to find a higher month-over-month change, you'd have to go back to January when it was up 0.7, although we had several 0.4 earlier in the year. If you look at spending alone, it is also up 0.4, and 0.4 is actually the lowest number since May of this year because it's following 0.6 and 0.8 higher. Now, if we look at real spending, that's up 0.1, so we could see inflation does take a bite out of that. Now, let's get into the deflator. The deflators are always important. Now, here's the month over month. It's up 0.4. That's a little cool to expectations, but if you compare it to history, up 0.4 is the highest level since January, which means it's the second, of course, highest of the year. Year-over-year numbers, maybe the most important aspect here. And keep in mind, the year-over-year deflator peaked in June of last year at 7%, expected up 3.5%, exactly as it is, up 3.5%, with an upward revision the last month from 3.3 to 3.4. Now, on the 3.5 front, that is the lowest, well, just since obviously last month, but it actually now becomes the highest since May when it was at 3.8. Not something I want to say. We don't like to see these things moving in the upper direction. Now, if we look at the deflator, personal consumption deflator, core month over month, expected up 0.2. It arrives at up 0.1, and 0.1 follows an up 0.2. And now, in my opinion, the most important number of all, the personal consumption expenditure core deflator year over year. And it finally breaks the 4%, 3.9. As expected, following 4.2, that moves to 4.3. And why am I so excited about this particular number? Well, consider this. It hadn't been below 4% since SEP of 21. Okay, last year alone, half the readings were above 5%. So it indeed is progress. But progress is slow. 3.9 is a long way from 2%. And to hear so many Fed officials seem to be so pleased at the performance of the drop in inflation, which I agree with, but these are still sticky numbers. Real quickly, let's take care of something else. Trade balance moved lower to minus 84.3 billion. We're expecting a number over 91. Wholesale inventories down 0.1%. Retail inventories actually up double expectations at 1.1. Interest rates are highly unchanged, but do keep in mind, I think yesterday we put an interim peak in treasuries. We'll have to wait and see. Becky, back to you.
Hey, Rick, core PCE, that is good to be back below 4% year over year, 3.9%. Core does not include energy. Energy prices have gotten a lot higher recently, and that's fine. You want to take out some of the volatility, but core energy prices eventually bleed through to a lot of other areas that would show up in the core, right?
I couldn't agree more. It is exciting to see we drop below 4%, but it's still on the high side, and you're correct. Most Americans right now, they don't agree with looking at things from a core perspective because at their core, and what bugs them the most, food and energy prices being very high. And even if these numbers moderate, and we've talked about this many times, it doesn't mean we're going back to where prices were pre-COVID.
Rick, thank you. Right now, Steve Leisman joins us. He has more on these numbers. Steve, what really jumps out at you?
Well, first of all, I want to go back to the question you asked, Rick, because I was talking to one of those, millennial types the other day, and the person was saying, hey, the government inflation numbers are no good because they take out energy. That's not right. The government reports two different sets of numbers. One is a headline number that includes energy and food. One is a core number that takes it out. You can look at whatever you want. I think you know this, Becky. Apparently not everybody does. I want to make sure people understand that.
Oh, no, Steve, my bigger point was that even if you are focused on core like the Fed is, and I understand the reasons for that because you want the volatility out, the energy prices
Right.
eventually feed back down the line into all kinds of stuff that is in CPI, whether that be delivery cost for things. It winds up in manufacturing, winds up everywhere. So higher energy prices, if they last, if they're not volatile, they do show up in the CPI.
That's exactly what I was going to say. I just wanted to make clear that there's not a great conspiracy going on to not report the higher energy prices. But you're right, Becky. That's why what I'm going to say about these numbers here is so far so good, but it's a little hard to take it too far, because what you have is you have the spike in energy prices, which you see in the rising headline number. The Fed is going to look through that to an extent until it becomes concerned that what's happening in the energy prices are feeding into the core. And that kind of gets us to why. Why do we look at the core? We look at the core because it's perhaps a better way to make policy over a longer term and to not go up and down with energy prices and food prices, which tend to be more volatile. And by the way, there are many other things published by different Federal Reserve banks that look at other volatile things and maybe takes those out, the trim mean things, other ways to look at inflation, all published by either the government or quasi-government agencies. Just want to make sure there's no conspiracy there. So what's happening is what I saw this morning, as soon as that number came out, is a little bit of lower probabilities on the outlook for the Federal Reserve this year. And I want to just give you the freshest quotes we got here. What I'm looking now is about a 32% probability for another quarter point. We'll call it 34 probability for December, another quarter point. And then looking to the cuts, 42% in June. What's happened essentially, Becky, is that the probability of a rate cut has moved more to June, July, and obviously the total amount of cuts baked in by the Fed and therefore by the market have come down for next year.